and I've been getting a lot of question, and I've seen a lot of people asking, how are you taking a trade here? You see no demand. What is the secret behind how you take your trades and all these things? There's basically no secret behind how I take my trades. It's just that it's just that you guys are not really familiar with a lot of models. So today I just decided to put it upon myself to teach at least 2 or 3 models to you guys. Aside these 2 or 3 models, I'm going to teach you a reversal or a continuation model. So basically, we're going to learn like 4 models: reversal, continuation models, and 2 other models. And also, I'm going to talk about my way of taking trades, whether A plus setup, B, C, or D. Basically, I'm going to dive deep into my strategy. So as you can see on the charts, I took a trade from here last week. I took a trade from here as well last week. So this is what has been going on for the past few weeks. Like I take trades and like I've been on fire for a while now. Yeah, so in today's video, I'm just going to do a top-down analysis, deep by deep, explaining types of POI that we have, explaining how to read markets with context to the daily cycle variance, how to go into the market, what to do, what to expect, what not to do, traps. We're going to deal a lot today. So I've got my magic book here. Yeah. And it's full of stuffs about trading, what to do, what not to do, and all these things. So yeah, um, before we continue, make sure you like and subscribe and share this video to your friends. So I'm going to divide this video into 2 parts. The first part is basically going to be about market structure, types of POIs, the daily cycle variance, and liquidity. That's going to be the first part of the video. Now, the second part of the video is going to be about how to use these 4 cycles: market structure cycle, liquidity cycle, daily cycle, and POIs. How to use these things in context with the markets, because an example is if you sit down and then you decide to wait till price arrives at your POI before you trade, it means that you're going to sit down for a whole month, and then within that month, price arrives at your POI, let's say once, and it is that one time that you're going to take the trade. However, that one time, price can just tap into your POI in the Asian section while you are sleeping. Before you wake up, price is already melting or very bullish in the morning, and you'd be like, ah, damn, so you have to wait for another month. So today, what we're going to do is I'm going to teach you guys how to trade in between sections, what to do, what not to do if price is not at your POI, what to do, what not to do. And I'm going to give credit to Wakasim because he's the one that I've been learning this from. Like I've been learning from. So I'll give credit to him because I've learned a lot from him and from his YouTube. So if you have a question, you can ask me in the comment section or in my Discord group. Also, if you think the question is beyond my knowledge, or if you ask a question and I'm not able to answer you, you can also pipe down to Wakasim's page, ask him questions on his YouTube channel, and I hope he replies you or gives you the answers that you need. So fast forward, we'll go to the charts. As I said, the first part of the video is going to be based on market structure, liquidity cycle, daily cycle variance, and POIs. So I'll start with market structure and POIs. I'm looking at the screen because I'm using a secondary screen as well. So once I start moving to the charts, I might not be facing the camera anymore. So I'll move straight to the chart and then we'll start. Cheers. All right. So since I have drawings on my charts for Euro USD already, I would have to pay Canada. But normally what I do is I trade Euro USD using the forex.com server. It's not anything special, but I would say I like forex.com as compared to other ones. So I would have to change. So let's see Euro charts. So let's use the Rwanda. Yes. So what do I do when I come to the charts? Now, first of all, I'll teach based on drawings, and then after that, I'll quickly move to the charts and then we focus on that. Now, we all know market structure. You guys are not kids. You've been in the market for a very long time. It's just that we've not been consistent or something. So I don't have to teach all these things from infants, but I understand that you guys know market structure. Market structure is market structure. Market structure has been market structure. It doesn't change. So if someone is using Elliott waves, if someone is using smart money, if someone is using ICT, the market structures are the same. However, there are different interpretations to it. So let's say, just like Christians, we have a lot of Christians, but based on the type of Christians or denomination that you belong to, you get to know how they deduce the Bible to you. So that's how market structure is. So market structure is market structure for everybody, just like the Bible being the Bible for everybody. Now, when it comes to market structure, based on your belief or your strategy, you have something to see about your strategy that makes you essential from other. So if you come to Christianity as well, even though it's the same Bible, even though it's the same Genesis, Church A will explain Genesis in its own way, Church B will explain Genesis in its own way. So that's how market structure is. So we have up, down, up, down, up, down, up. Yeah, that's market structure. So it basically means how price movements occurs and then blueprints are left on the market for us to read or something. So now these banks trade in such a way that whenever price goes up, price has to come down to take more supplies and then go up. So once price is going up, it means demands are going up. Do you get it? So let's say an iPhone product comes in. Now, once the iPhone product, let's use iPhone 17 for instance, once iPhone 17 is about to be released, you realize that a lot of people going forward to pre-order and all these things. So it shoots the price of iPhone 17, even though it's not in, it shoots the price up. So in that case, a lot of demand sets in. However, after some months, if the iPhone 17 is now out, after some months, the demands of iPhone 17 starts dropping. Now, why does demand start dropping? In this case, a lot of people or a lot of supplies are in. Do you get it? So let's say before it came out, it was only Apple you could get a pre-order from. Now, once the phone is released, there are a lot of wholesale shops around that you can get iPhone 17 from. So in that case, supplies are more and demand from Apple shops are very less. So in that case, price has to come down. You get it? Price has to come down to a discount level for people to demand for iPhone 17 again. And when people demand for it again, the price then shoots up. So when price of iPhone goes high, this is demand. A lot of demands are in. Now, when demands are saturated, they need to what get supplies in. So when supplies gets in, now these supplies drive price to a discount point. So if you have a leg, you ask yourself, this leg that I'm having, this reach that I'm having, where is the discount point here? I'm going to explain how to know that this price, because sometimes, let's see, if you have an item, let's use an iPhone 17 as an example. If you have an item, let's say initially the price was £1,000. Now, when a lot of supplies gets in, it takes the price to a discount price. However, it cannot take the price to a lowest discount point. Let's say from £1,000, you can't get an iPhone 17 for £300. As at now, the demands are very high. You can't get it. So it means that there are some discount prices that are not really, really, really sufficient for the products that we are having. So just like EUUSD, at a certain point in time, there is no way price will come to the extreme. If I say extreme, I mean the extreme of the range. There is no way price will come to the extreme of the range. Sometimes we will just come halfway and then go away. It means that at that particular time, the suppliers were not what able to drive price to its lowest discount price. I think this is the best way I could explain market structure. Now let's continue. However, when price is going up, down, up, down, up, down, up, down, there is two things that we are supposed to understand. What do we do? How do we know that price is reversing from here? What do we do if price is reversing from here? So there are terminologies that we are going to study in this particular cases. So now, when you have a range, which is from here to here being our range, or we call it the main push, being our main push, you ask yourself, do I have these criterias for price to be able to predict that price will reverse at this particular discount point? So now you have this main push, price is having a complex pullback. We call this pullback a complex pullback because when price is going up, because of its impulsive moves, it moves very fast in a short period of time. But during the pullback or the complex pullback, during the supplies, it takes a very slow and choppy time to arrive at the discount zone before price shoots up again. So we have termed that pullback as a complex pullback, and these complex pullback are what actually traps retail traders or traders like you and I. So if you want to become a good trader, you should understand and be able to read these complex pullbacks because these are the pullbacks that one is going to fetch you money, two is going to liquidate you, and three is going to make you very rich. Yes. So you have to understand these complex pullbacks very, very, very well. Now, when price pushes up, it comes to a discount zone. Now, the question is, where or how does price reverse from these discount zone? And that is where POIs comes in. So POIs, now POIs are areas that price actually sets in before the impulsive move happens. So let's say you have a push, price comes down, your POIs, this whole zone here, the price where price sits before another impulsive move comes. The PY will be here. Price sits before an impulsive move. Price sits before an impulsive move. Now we have types of PY. We have four types of PY. The first type of PY is we have the supply, we have the demand. These are the major two types of POIs that we have. Now the other types of POI, we have we have six types of POI. You know, we have the supply and demand, which are the very important ones. Now, I'll be putting them on the screen. So we have supply and demand. We also have um we also have the supply to demand POI or demand to supply POIs. I'm going to explain that. We have the smart money trap POI and we have the weak POIs. Yes. So they are the weak POIs are actually two. That's a weak demand POI and then weak supply POIs. But I have actually made it to one. That's why we are having five on the screen right now. Now I'll take the supply and demand POIs and explain it on the drawings, and then we'll go to the chart. Then I combine it. Or now, when we take a supply and demand, assuming that we have price going up, down, up, down. Now, when price is in an uptrend, we look for demands. Do you get it? So as I said, if demands are where price sits before price shoots up. If price goes up, it means demands are in control. So now, where is the lowest part that price could sit, that supply could sit? Do you get it? Supply could sit until demand sets in. So let's say we have a particular product. Now, we can only get up to, let's say, six supplies. Now, if extreme demands come in, there is no way these six suppliers can supply 10,000 people. It means we are supposed to get more suppliers. So the demand zone is where suppliers can no more supply adequate goods for these demands, those people looking for the product. So that area where suppliers are saturated, that is your demand zone. Do you guys get it? The point where supply is saturated, that is your demand zone. And so on the screen, this demand zone here is the point where suppliers were saturated. Now, how do you get to know if suppliers are saturated? If they are saturated, they will leave a blueprint on the screen for you to see it, that we are saturated. Just like when you're in a relationship and you feel like the relationship is going to end, you feel it, you get the signs of it. It's the same way. When suppliers are saturated, you get the signs on the chart. It's just that we sometimes see these reactions from these people when we are in a relationship with like, oh, this relationship is going bad, but we decide to flag it off. And now, the more you flag it off on the chart, the more you lose money. So the ability for you to understand these flags are what we are going to do today. Now, in the same way, when prices are selling, suppliers are enough. Now, the point where demands can no more exceed the supply, or demand is also saturated, at that point is where we call our supply, or a supply zone. Do you guys get it? So now, how do I read market structure? I'm teaching the demand and market structure in concise with the POIs because they move hand in hand. Now, if price comes down and price starts moving up, breaking internal structures, note this, internal structures are different from external structures. So what do I mean by internal structure? When price is coming down, price doesn't just come down. It gives reactions, and these reactions leave blueprints as well. Everything on this market leaves a blueprint. So now price comes down in this way, arrives here, starts giving pullback. Now all up to down here is termed as our external structure. External structure. Now, these in between legs, small legs we are having, is termed as our internal structure. So, taking the morphology of a human being, you have your external parts that you can clearly see, your hands, your lips, your face, whatever. Now, within you, you have internal structures in you. Your esophagus, your intestines, and all these things are what? Your internal structures. Now, when it comes to the charts, we have external and internal structures, just like the anatomy of humans. Now, on the charts, these internal structures tend to confuse retail traders because if you are not really careful, you might think, oh, this is a break of structure, but rather it's rather an internal break of structure. And you know, internal break of structures are in to what? To tell you that there is a complex pullback about to begin, rather than a break of structure. So an internal break of structure is different from a break of structure, because a break of structure is when the external highs and lows, or when the external high or low is broken. Are you guys getting it? Now let's continue. So now when a complex pullback is about to begin, internal structure gets broken. Now when this internal structure gets broken, you ask yourself, what is about to happen? You get it? You ask yourself, are supplies or demand saturated now? Because if price is going up and was forming this going up, and suddenly we had internal break of structure, you ask yourself, are demand saturated now for suppliers to set in for the complex pullback? How do you know that? That's where liquidity comes in, liquidity gaps comes in. We'll tackle that as well. Now, price arrives and starts giving internal break of structures, giving two legs, three legs. Then it tells you, oh, yes, at this point, demands are what saturated and supplies are setting in. So now they start setting in, and that is where you start trading the complex pullback with context of the daily cycle variance. Now, if price goes up, comes down, goes up, fail to break this high, comes down and breaks this high here, then we have another type of POI. Yes, I think I've remembered the last one. We have another type of POI called the decisional zone. Now, the decisional zone is here. Why here? So whenever you have a main push, you have two zones. That price could what or two discount zones that price could come. The first discount is about 50% discount, and the second one is the extreme. When we say extreme, when price comes, it's its lowest range. So if you have this zone here, price pushes back to its lowest range here before it pushes up again. And then the decisional is when prices comes low, goes up, fail to break this high, comes down, fail to break this low, and then shoots up. Now, after giving the break of structure, this zone here is what caused this break of structure. However, the impulsive move of this entire move here started from this guy here. And so for that matter, this zone here becomes our extreme, and this zone here becomes our decisional zone. All these two types are normally in the supply and demand. That's why I didn't add it to the types of POI. However, it's also a type of POI. So the types of POI that we have is extreme, decisional, supply to demand, demand to supply, smart money trap, and a weak POIs. Now, we have understood structure, we have understood POI. Now, the question is, let's go to the chart and let me show you something. Now, 2 hours. Now, if you look at the chart from this perspective here, you realize that price was forming lower high, lower low, breaking this low here. It was this low that pushed price to this up here. Now, when price was breaking this low here, you see this was the first move. This moved here, failed to break this. Let's do this. Let's make it very, 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 very productive. Ignore the side of the market, ignore the left side. Let's focus on the right side here. Now, price pushed up, break this low here, form this low, now lower low. Now, when price was coming, price initially came down, failed to break this low, and pushed up. Now, this guy here, this momentum here is what broke this external low, sorry. However, all this break of structure was caused by all this impulsive move. This break of structure was caused by this impulsive move. But this guy here is what caused the break of structure. So we will call this guy here decisional, and we'll call this guy here extreme. So when you are marking it out, this is how it's marked. So now we are selling, so it's called supplies. So supply and your decisional. Do you get it? Supply and your decisional. Now I'm going to explain to you guys how to draw these supplies and demands, where to draw them, how to draw them, how to classify them. We are going to get there, but for now, we shouldn't get ahead of ourselves. So now, within this main push, we have extreme, we have supply, we have extreme supply, we have decisional supply. Now, this was our range. This guy here and this guy here. Now, when price was reversing, price tapped into the what? Decisional and formed a new low, breaking this previous low. Now this becomes our main push. However, when price was coming down, price formed this low, failed to break this one here, went up to this guy, and then this guy here pushed down, failed to break the low again, came back again before the low was broken. Now the question is, which one will be my decisional zone? Because we know this is our extreme in this leg. For this leg here, we know this is our extreme. Extremes are very easy to identify from the chart. However, the decisional zones are tricky sometimes. The decisional zones are very tricky sometimes. Now, how do we get our decisional zone? Because this could be our decisional zone. This guy here could be our decisional zone. We can get 3 or 4 decisional zone, but then qualification comes in, and I'm going to teach the qualification in the same video as well. Now, now in this range, we have 2 decisional because this guy failed to break this low, came up, and this guy then broke this low. However, however, you see this zone here, when price got there, price just decisional, price just tapped in the decisional zone and our extreme zone. Again, I'm going to explain how to draw these things. So you identify your push, identify your POIs. Decisional and extremes are very important. These are the 2 major ones. The other ones comes in the S to D, D to S, fake, smart money trap. All these comes in the lower time frame. So on the higher time frame, you looked for 2, decisional or extreme. On the lower time frames too as well. For them, they are everywhere. But for those S to D, smart money trap, all these things are on lower time frame. That is where we are going to pay attention. I'm not saying you wouldn't see smart money trap on a higher time frame. In fact, they are everywhere. But then we are going to pay much attention to these things on the lower time frames. So now we are still on structure and POIs. You've identified your main push from your reference from your previous low. You've identified your POIs, extreme and decisional. Again, price came to this far end and push down. So now we have this as our main push. When price was coming, this was our reference previous low. When price was coming, it failed to break the low, went up and broke the low. Decisional, easy to identify, clear, extreme. Price taps into decisional. Now, after tapping into the decisional here, price failed to create a low. And now what? Went up to break the structure here. So now we see price as what shifted structure, or there's been a break of market structure. Do you guys get it? Good. So now we understand this. Now the question is how to draw demands and supply, how to classify these demands and supply. Now, how to draw these POIs. Let's use let's use the same example for it. Now we had this impulsive move from the top. This low from this high. We had a break of structure here. Now we know that this is our decisional, this is our extreme. Now the question is, how do I draw them, because if I'm to use anything, it means I'm going to get a huge candle or a huge demand in supplies. Now, since we are selling, we are going to look for supplies. So what do I do in this particular case? What I'm going to do is your demand, sorry, we are dealing with supply. So your supply is the, when it comes to the extreme, the last, since we are dealing with supply, the last buy before the sell occurred, the saturated points, the very saturated point is where your supply should be. So if I see the very saturated point, I mean, this was the last buy. You see, at a point, all this week was a buy candlestick before sellers came in. Now you see how huge this is. Then the qualification comes in, the criteria comes in. Now, how do I qualify a POI? Before you can qualify a POI, one, the POI should have a form of liquidity grab. So if I say a form of liquidity grab, types of liquidity grab, we have trend lines, we have head and shoulder patterns, we have double top, double bottoms, all these liquidity, all these stuffs, retail trader stuffs are liquidities. And so when there is a liquidity grab, it qualifies the POI. So now in this case, we had a trend line here on the lower time frame. You're going to see that. And we had the sweep of that trend line to invite buyers, and now sellers set in. Now the next thing is, this is how to qualify the POI. Now we are going to draw a correct POI. How to draw a correct POI. So now you qualify the POI. Once you've qualified the POI, you draw the POI. Now upon drawing the POI, it also has its requirements. Now the requirements for drawing a POI, one, the POI should have a sweep, of which we have. So if the POI has no sweep, it means that it has failed at the qualification stage, and it has also failed at where the point at which we draw this POI. Because how to draw it says you should have a sweep. The qualification says you should get a sweep. So in this case, we have a double sweep. So it means that before you draw any POI, that POI should have a sweep. It means that without a sweep, that POI is very likely to be classified as a weak POI. So now you see, I've now explained the weak POI. Now, qualification, you should have a sweep, and the sweep is what? Either trend line, whatsoever. And also, you should go ahead and cause a break of structure, internal break of structure, and you can clearly see that happened on the screen. Internal break of structures were breaking from these all POIs. Now, since the extreme is what initiated all this push, it means that there was a break of structure. So don't say it is only the decisional that caused the break of structure. The reason why decisional zones are very powerful zones are, these are the major cause of the break of structure. However, all of them initiated from this zone. So 80% of decisional zones will hold, and 45% of decisional zones will hold. But there's a high probability of your extreme zones, 45% of extreme zones will hold. There is a high probability that your extreme zone will fail when your decisional zone fails. So you have to be very careful with them. Now I'm going to explain how to know whether they will fail or not fail. So you are going to get to know and understand all these concepts. Now let's get back to the chart. Now we've been able to classify the POI. Now, requirements for us to draw the POI. Your first requirement is you should have an impulsive move. So now you can clearly see when price arrived here, price started going down. Now, an impulsive move is when, or displacement or anything, is when you see in long balanced candlesticks, long imbalanced candlesticks, sorry. So the move here is a displacement or an impulsive move. All this move here is an impulsive move. So it has a lot of imbalances over there. You guys get it? It has a lot of imbalances over there. Now, how do you draw your, or the requirements needed to draw your POI? One, it should have an imbalance or an impulsive move. So you have your impulsive move. It should have an imbalance. So the last saturated point should have an imbalance. Yeah, so we are going to so the decisional zone, I was saying before you can draw it, it's at the saturated point or the extreme zone. The supply, the POIs are always at the saturated point. So at this point, when by a setting, they got saturated over here. Now we are coming to classify this decisional zone, how to draw them. Now, what happened before? Does it qualify to be a decisional zone? Yes. Why? Because there was this trend line here. You get it before the sweep of that trend line. You're going to see this more of it on the lower time frame, but you have to be very vigilant when it comes to these things. So there was this trend line here that got swept here. Okay, now where there impulsive moves, you can clearly see bearish candlestick, long bearish candlestick. Yes, so where is the saturated point here? Was there an imbalance? An imbalance is a space between two candlesticks. So you see this candlestick was going up. This candlestick is coming down. Now the space between it's this space here between these two candlesticks. The space here between these two candlesticks are called imbalances. The space here between these two candlesticks are called imbalance. It's not every candlestick that have an imbalance. So I'll show you one that does not have an imbalance. So, so, yes, the candlestick 1, 2, 3, it doesn't have an imbalance. This one has an imbalance with this and that. This one has an imbalance with this and this guy here. I want to show you guys one with no imbalance. So, an example is 1, 2, 3 candlestick has no imbalance because this candle has intercepted this candlestick and then sandwiched this guy inside. So uh, there was no imbalance. An example is also here. There was no space between this candle and this candle, so no imbalance. Intersections, but there is a small imbalance with one, two, small imbalance here. So that's how you identify imbalances. So now it has qualified, it has an imbalance, and it has gone ahead to break this low here. Yes, so then I will draw my decisional zone from the last bullish candlestick to here. However, I said it's the last buy to sell candlestick. So normally we draw it like this. However, you have to be refining your POIs. Do you get it? Whenever you are drawing a decisional zone, just take the last to buy candlestick. When price arrives there, start reading price, start investigating price at that area. It is good to refine your POIs, especially on the higher time frames. I would advise you that you leave it like that. When price arrives there, go to the lower time frame and try to read price, investigate price from there because there are so many instances where price arrives at a POI. And because we've refined it on a lower time frame, we tend out losing the trade or missing the trade. An example is an example is what I have right now on EU here. Is what I have about EU over here. You see, price never arrived at this POI, and now it's giving a sign of sales. It's giving a sign of sales. Yes, we are going to deal with that as well. And now, how did I classify that POI? You see, there was no imbalance here. This candlestick intercepted with this. There was no specific imbalance until this imbalance here. And so, if I'm to close that imbalance, I'm to close that imbalance and take that last candlestick that caused the imbalance, which is here. Realize the price tapped into its, you get it, the last imbalance. You realize the price tapped into it. But however, we tend out to always refine because the more you refine, the higher uh risk reward you get, and that's what we normally pay attention to. So yeah, let's continue. I think I need to USD, USD, Rwanda, right? Rwanda. Mm, Where did our drawing go? Was it Rwanda? Yeah. Anyways, let's continue. Yeah, yeah, it was it. So you've learned how to draw your POIs. Now, classification is when there's a sweep. Requirement is long imbalances, um, cause a break or structure, and a sweep. Yes, so all these are requirements. Now that you understand how to do this thing, I'm coming to show you how to read. Oh God, how to read um this with how we are going to trade the market. So what I do is, oh God, what I'm going to do is I'm going to start from the higher time frame, read structure from there, and use the ideology of that to explain POIs and market structure and daily cycle variance and liquidity. Now, when we get to the part two, of which I'm going to release the video later on, I'm going to explain how you are going to classify your trades, how you are going to trade the reversal and what's the reversal and continuation models, how you're going to add all these contexts together and take a trade, how you're going to grade your trade. I'm going to keep all these things out. So yeah, make sure you like, you subscribe, and comment. Let's continue. So we had this high, causing this low, price came up, failed to break the high here, came down, and this was what caused the high forming. Now, just before the high was formed, another low formed before the high. So now in this case, we have two decisional zones in that context. We have this zone and that zone. So now you have to zoom in when it comes to these things to get to know them. Now, this decisional zone had a trend line, had an inducement. Now the question is, where is my imbalance? This is where we had an imbalance. So that would have been our demand zone. You see how price tapped into that demand zone and pushed up. When pushing up, created a high, came down. Now, when price was going up, there was no imbalance until price arrived here. So all the zone here becomes your what? Your POI. Price came down, tapped into the POI. How do I know if price is about to settle? There was a build up, there was a graph, there was internal breakout structure, there was a mitigation. This is where you look for your trade. How do I know that here is a saturated point? There was an imbalance here. Price sits in, price then moves up. You can clearly see displacement all over the place. Now, what happened? Sell, buy. Now, as I said, always take the range. So it was from here price sold. So you take your range as your demand. Price arrives there. Price taps in. On the lower time frame, we investigate that price tapped in, went up. So now our range is from here to here. This was our external points before price broke. Now price came up, failed to break the high, came down, failed to break this low, then went up. Now this one here is what caused price to break. Now we have what extreme, sorry, decisional and extreme. Now, as I said, always take the whole leg when it comes to the higher time frame. When price arrives there, read it and investigate it so you can see all this leg, price then comes, sits in. How do you get to know if price is about to push up? There was a build up, there was a sweep, there was internal break of structure, there was a pullback, and price pushed up. Now, after pushing up, price moved this high. Okay, where's my extreme? This is my extreme. Did price fail to break the high? Yes, it gave this reactions here before price slowly broke the high. Then where did the reaction start from? It started from here. Okay, in the future, price comes there. How do you get to know? You get trend line, you get inducement. You take the shade. Now, our aim is not to hold the trade till price breaks the high because of the way we trade. The way we trade help us to get a smaller stop loss and a higher risk to reward. So you realize that even this here to here, we can make like a 50R from this trade alone, this push alone. And that's how beneficial this strategy is. Because it makes your risk to reward very huge. Your risk is very small. 3 pips, 5 pips, 6 pips, maximum 8 pips. And your reward is very huge. 10 hour, 3 hour, you take your partials very fast. So same thing, you price taps in, react. Even if that zone is going to fail, it will give the reaction, and that is what I like about this trade, and that is why we are called reactional traders, because we react from highly possible zones of the main push or of the complex pullback. So highly possible zones are here. This is the main push. Highly possible zones of the main push are what we are having here, and you can clearly see. Now, where is sorry. Now, where's our main push? Our main push is from here to here. However, what are we having? A complex pullback. How do I know that the complex pullback is about to begin? We should have an internal break of structure. We said all these before. So where is our internal break of structure? It was this low that formed this high. Price breaks it. Oh, okay. Then we're having a complex pullback. Okay, then let me quickly look for my decisional and extreme. Where's my decisional and extreme? It was this guy that started this choppy reaction that broke this external high. Okay, then what do I need to do? Let me classify that guy. Let me see if he qualifies our requirement. Okay, let's see. So we had this relative equal lows. We have this sweep, and price went ahead to break this. Okay, we have an imbalance here. Oh, okay, you qualify, you meet the requirement. Then let me take the whole PY. Now, upon taking the OPL, you realize that some are stacked up in, so you then refine it and then you push it to your right. You get it, you push it to your right. Now, this is my decisional. Okay, fast forward, I mark it as my decisional. And then where's my extreme? My extreme is always my extreme. Does it meet the requirement as well? Let's see. There was a build up, there was a sweep of this build up. We went ahead to break structure. There was an impulsive move, there was an imbalance. Happy to call you my wife. Happy to call you my decisional extreme zone. There you go. Now, decisional zone. Price arrives at the decisional zone with context. Happy to take the trade from there. Read context. I always see this. Now, when I say with context, I mean the daily cycle variance. So now let's use the daily cycle variance. Let me explain the daily cycle variance. So let's see you have an Asian section. This is our Asian section. This is our main push. Price was coming. Now let me do it well. I know I really suck in drawing. So yes, guys, let me draw this well. Good. So we had a low, we had a high, we had a low, we had a high, we had a low. Good. Now this is our Asian section. Now when price when price, so now the first thing, identify your main push and know where the price is. So now we've identified that this is our main push. Identify your main push. We've identified this is our main push. Two, identify your previous low that was broken by your main push. This is our previous low that was broken by our main push. Okay, was there a reaction that caused the main push to break this low here? Okay, in this drawing, there wasn't any reaction, so in this case, we would have had only extreme. But in the case when we had something like this, no, let's continue from here. So now we had only, since there was no reaction before this low was broken, we have only one POI, which is what I extreme, because in this case there was no decisional. Now, with context, let's say there was, let's say we had this small pullback and then a lower low again. Now, just before our Asian section, there was an internal break of structure. There was a two-leg protocol again. Price started going up. Now, we are coming to add this with context. With context, I mean that we are in a main push, but internally, we've had an internal break of structure, which tells us that the complex pullback is about to begin. So now, if the complex pullback is about to begin, then what do? We are going to take this complex pullback and we are going to trade till we arrive at the what? The supply or the saturated zone. So where our saturated zone is what Waka calls the efficiency of the pullback. Saturated zone or the efficiency of the pullback. So supply. So in this range, this is our extreme. In this range, this would have been our extreme, but we are no more in that range. We are in this range, so that's what we focus on. Now, this is our range. This is our extreme. Asian section is coming. In our Asian section, if you get price giving you build up, inducement, up, build up, inducement, up, build up, inducement, up, leaving this trend line here, build up, inducement, up, build up, inducement, up. Now, let's see, price then arrives here. We had all these trend lines, liquidity. So now see how we are going to build our narrative. One, we know prices in a main push and now price is having a complex pullback. Two, we've identified our previous lows and we know how price arrived there and we've been able to classify our POIs, our requirements, everything is set. Now, what we are going to do now is during the opening of Frankfurt, this is what happens. The market is going to give an internal break of structure. This is the minute of Frankfurt. Gives an internal break of structure again without arriving at the POI. Note that, remember, we have imbalance. We've classified this POI. We know that this POI is very perfect for us to take. Now, price then gives internal break of structure. It gives lower high, lower low, lower high, lower low. Now, remember, this is our Asian midline. Now, price arrives here. Do you get it? Now, when price arrives here, this is what is going to happen. If I come to the market, I know that price has arrived at the what saturated point or efficiency of the pullback. So what I'm going to do is I am going to look for a continuation buy into that POI, into that saturated point, into that efficiency of the pullback, into that Waka has another name for it, into that inducement of the day. Yes. So now you've been able to identify it. You've been able to read your narrative. And now you've been able to identify your range with your perfect POIs. You've been able to read the details of Asian section. You've been able to identify the traps. Now, where is the trap? The trap is this trend line. Another trap is there are going to be traders who are going to take smart money traders who are going to wait for, they will say this is a break of structure, so they are waiting for pullback and trade. And so this is where their POI is, and that POI is what we call a smart money trap. Why? Because we have not arrived at the efficiency of the pullback. We have not arrived at the saturated point. We have not arrived at any POI for price to now reverse from. And so what I will do is I will wait for an Asian midline inducement. So let's say in this case, this is our Asian midline inducement. I'll either, if this leg was a long leg, I'll either wait for a two-leg protocol with listen, a two-leg protocol with divergence to GU. If I'm trading EU, with divergence to GU. If I'm trading GU, I'll look for a two-leg protocol with divergence to EU. And you guys know what divergence is. I've explained this to you on previous videos. A divergence is when this, let's say EU is forming lower lows and GU is forming uh it's let me explain it all. If a divergence is when GU, let's say GU is forming lower low and EU is respecting the previous low. So this is respecting, this is inducing. If that is happening, then it gives you a confirmation of your trade. And in that case, I will look for a buy, and my stop loss will be at the protected low of that divergence. Or if I'm trading EU and the divergence is GU, at the low here, I'll protect it and I'll take it the trade into here. Now, why am I taking the trade into here rather than just going by the rules? Like I said, 1:3 partials. In this case, I know that the inducement of the day is in that POI for price to continue the bearish trend. So I would rather secure my 3% rather than taking 1.5% in this case. However, if the trade was a continuation trade for the main push, I would have taken my 1:3 partials and then let the trade run to 1:10. So now I'll look for divergence with two-leg protocol and internal break of structure, any of them. Even if there's an internal break of structure, you should go with the divergence. So internal break of structure with divergence to GU, going for the trade. And that is what happens every time. I'm going to show it to you on the chart. And now when price gets here, price gives the reaction, gives the trade, and now takes on to here. Now when price arrives here, because price is aware that smart money traders are also trading from that end, it will give a reaction. That is why normally we get our FOMO. No, this is not even FOMO. This is where normally we react. We'll be like, oh, the trade is coming back to my entry. Let me close it, and we close it, and before we realize, because this was a smart money trap, it has to give a reaction. So it gives a reaction, and sometimes the reactions are very deep to the extent that it comes deep into this before. But sometimes we don't get the perfect entry. So when it comes deep, you get that, oh, I was in profit, I'm now in drawdown, panic, you close the trade. No, that is why you should know smart money trades, like smart money zones. Now, these smart money trap zones give the reaction and now goes ahead to arrive at the efficiency of the pullback. Now, when price arrives at the efficiency of the pullback, another thing happens. Gives a reaction. Sell, invite sellers, go deep into it, induce them, and then now break internally or give a two-leg protocol. Break divergence. Don't take a trade without divergence. So don't take a break of structure trade without divergence because it has to happen. That is what I have realized. It has to happen. So now, build up inducements. Now, whenever you are taking a trade, ask yourself, is there enough fuel for price to continue going up? Or is there enough fuel for price to come down? If there is no enough fuel, be careful because you might be the fuel for me, or I might be the fuel for you if I decide not to learn. So now, If there is no enough fuel has there been a grab of liquidity when price arrives at the PY? If there's not been enough grab, please wait for further confirmations. If there've been enough grab, if I say enough grab, I mean when price arrives at the POI, give internal break of structure and then went up to clear that internal, because at that point, if it gives internal break of structure, everybody smart money trader, oh, internal break of structure, smart money. Let me then put my POI at the extreme. Now price then peers into their POI, sweep their POI, they are the drawn, and now price melts to form a new high, a new low, and that is what we are going to do. So we've combined this with context. Now let's go to the chart. Let's do that. Let's take a particular trade, a particular trading day, and then I'll explain that. And then after that, we'll end the video for the first part of the section. Now, so guys, let me use this as an example. So what did I do? I found my main push. I identify my uh, decisional zone. Decisional zone came down, failed to create a low. So if price is coming again, then I know that it's no more a decisional zone. Because how can you be a decisional zone without forming a low? Like, bro, you see, how can you be called a trader without making money? Nah, don't mind me. But like, yeah, how can you be called a decisional zone without forming a low? Then, bro, you're not a decisional zone. You don't qualify because our qualification says go ahead to break structure. And this motherfucker here decided not to break structure. And that is why I know if price is coming, I know this guy here has something to do with that. And you know the funny thing? The question is, why did you know it was a smart money trap, but you took that trade? Because I took this trade because I knew perfectly that it's a smart money trap. However, I said something about smart money trap. Smart money traps will give a reaction. And what time frame was this? It was a higher time frame smart money trap. Then it means that I will be able to identify this higher time frame smart money trap, take the reaction on a lower time frame with smaller stop loss, and get a 1 is to 10 and leave. I think I had 1 is to 7 or so. I left because I think it was I don't remember. Yeah. So that is why I took this particular trade, and I'm going to explain that particular trade on the lower time frame. So don't worry. Now you can clearly see how it arrived, gave a reaction, arrived at the saturated point. Why is this a saturated point? Because it was this here that formed this high, breaking this guy here. So I took the trade, arrived there, went up to form another high. Now the question is, now that I know that this is my extreme, this is my decisional, I've identified them. Sorry, guys. I've identified that. So that's my range, as you can see. That's my range. Now, I've identified my decisional. Decisional failed me. Then I know extreme is very likely to hold. Now, the question is, you see, with this, the imbalance was here. So, yeah. But price never arrived there. But then I realized that with further confirmation, I realized price was not going to come there and price was going to continue going down. Because in actual sense, the whole sell to buy was here, buy to sell was here, but I've refined it still here. Now, I've I've been able to identify this. Now, price is here. So I don't have to give a fuck about all these things. What I have to focus on is this guy's here. So what do? I read build up inducement. If price is going up, price doesn't go up like that. It gives build up inducement up, build up inducements up, build up inducements up like that. So now these are the build ups. These are the inducement one, inducement two, inducement two, build up inducement, build up inducement to the upside. Now this is since this is my main push here, where is my extreme? My extreme demand will be here. Because now I know price is here. I know price is coming to this guy, but then I also know that price is in a complex pullback. And so the complex pullback, I will trade forever till price arrives at the POI. But it doesn't mean I'll be looking for buys till price arrives at the POI. No. It means that even within that small internal range that I'm focusing on, if I get an internal break of structure within that small internal range again, it means I can likely take the complex pullback. So now on the 4 hour, this is my range, internal range. On the 4 hour, this is my external range. Now, in my 4 hour, if I come to my lower time frame, the 15 minutes or the 30 minutes, that 4 hour internal range becomes my external range on the 30 minutes. Do you guys get it? Because that is where I'm going to focus, because I'm not going to look out for all this and sit down and wait. No. So this 4 hour internal range is what I'm going to focus on internally on the lower time frame. So now this is my internal range. Now, upon getting that, I move quickly to my 30 minutes. Now, upon arriving at my 30 minutes, now this is what we are going to focus on. We are coming to look out for this trade first. Why I took this trade. So for this, I knew perfectly that price arrives at a smart money trap and gives a reaction. So I had internal breakup. I think on the 1 minute there was a two-leg protocol. I'll show it to you when I get there. And I took that trade. I protected my highs, and I knew price will react from, because this was the range. Previously, this was the range. This guy here, price came back to the extreme zone. If you want me to show you, here you go, extreme zone. Yeah. So this was my range, my 4 hour internal range. Remember, my 30 minutes external range now comes to a, because this was an impulsive move to the upside, there was no decisional, comes to extreme. Now this guy here failed to break this high, came down, gave a reaction in the Asian section, break, pushed up. Now what happens? If that is the case, then I have a build up inducement. Now price pushed from there, then it means that all this is my main push. However, this is my extreme, this is my decisional. Took the trade, arrived at my efficiency of a pullback for the decisional, had an entry with divergence, took the trade, targeting that smart money trap high here. Price broke it. Before price broke it, now listen, this was also a smart money trap. Why? Because, as I said, you can't be a POI without forming a break of structure. It's like being a gangster without smoking, bro. You are not a gangster. A gangster is someone, yeah, gettable, shreddable. That's who a gangster is. You can't be a gangster with, bro. So you can't be a POI without, you can't be a perfect POI. You, this guy, you can't be a perfect POI without giving a break of structure. So now, once you fail to break a structure and you're coming back to you, then you are what? A smart money trap. However, this smart money trap here is a small smart money trap. So it means that it will give a reaction, but that reaction might be very small. And that's why I didn't take this reaction. But the other reaction was on a 4 hour. So I knew at least I'll get my 1:3. So you see when to trade it with context. This is also a smart money trap. I never traded it. Why? Because it was a lower time frame smart money trap. So the reaction will be there, but the reaction will be small. So you can see that reaction before the buy is what we call a supply to demand. Smart money traders know it's a supply. But what happened? It gave the reaction and broke it. So whenever a smart money trap gives a reaction and breaks it later on, that new demand that is formed is what we call supply to demand. The reaction that smart money trap gives before breaking, that zone there is what we call the supply to demand. And those supply to demand also work. It gives a reaction as well. So you can clearly see how price arrived here, gave a two-leg protocol, came down, tapped into the supply to demand. Even though trend has changed, it gave the reaction, as I was saying. So it gives the reaction in our Asian section. Now, since you know it has given a reaction, what do? You just wait. In the next section, it gave this main point. So now, on my 30 minutes, this is my range. Why? Because we had this internal structure that formed the high. This internal structure that formed the high here. Now that internal structure came ahead to break this structure here. So now we've had internal break of structure. So now all this main push, all this our main push here all this main push here has, where is it? Okay, now. Yeah, so all this main push from here to here had an internal break of structure breaking here. So now we've had a complex pullback starting. And now where is it? This is our decisional or the supply to demand. And this is our extreme. I've been doing this, so I know how to classify it. Let's classify it. There was build up, inducement, break of structure. So this is my extreme. Now, I am going to take cells into this, and that is what I do. But it doesn't mean I'm going to hold this trade until price arrives. No, that's when Wakasim comes in, makes it with him, and he's really, really helping me. So now, how do I read details of Asian section and add it to this? So now let's do it. So now I've been able to identify my internal range my on my 30 minutes or 15 minutes. Now what do I have to do? I'm coming, guys. Good. So I've identified my internal structures, and that is what I'm going to focus on the 15 minutes intraday section. So this is my main push that I'm going to think of. What do I need to do after identifying main push? Pause the video and think about it. So what you're supposed to do is identify your previous low that was eliminated by the main push. So my previous low that was eliminated by this main push is here. Okay, was there a reaction before this low was broken? Yeah, there was a reaction here before this low was broken. Okay, then it means that that's my decisional zone. All right, how do we classify our decisional zone? Let's do it. Okay, so we had a build up, we had an inducement, we had imbalance and impulsive move. Okay, but then what happened? Price arrived at the decisional zone in an Asian section. No problem. You were asleep, you woke up. Price has then arrived at our extreme. Then what do I need to do? Price has arrived at what? Our extreme. We are in a range. Price has arrived at the extreme. What do I have to do? Then I have to see if there's been enough liquidity. Where's the liquidity? Okay, there were people who took cells, who never slept and took cells from here. They've been swept off. So now this becomes my what? My medium inducement, because it's a structural point that formed the low. So now this becomes my medium inducement. Now this medium inducement means I have enough liquidity for price to come down. Then what do I need to do? I'll look for a two-leg protocol. Now price comes down, went up, comes down. On the minute of landing, taps into our PY, that's the two-leg protocol. I've been giving this for a while. Because in this case, there was no internal structure for a break of structure to happen with divergence. With this case, there was a push and a two-leg protocol, which mitigated the second leg. You take your trade from there, you protect the high, and you let it run off. And for now, I'm on break even with the trade. So I'm just going to allow it to run. Just allow it to run from a new low. So now let's look at the divergence with that. You see lower high, lower low, respecting lower high, forming lower low. Now let's look at GU. What was it? Good. So see, when I say with respect to GU, this is what I mean. Lower high, lower low, lower high, lower low. Inducing. This is where the divergence is. This guy here. This guy here. This guy is where the divergence is. So you can clearly see 725 and 85 respecting GU. 725 725, where it 725 and 85 inducing. Perfectly done. Now you take your trade from there. So you see how we've added context. That's a Asian section, details of Asian section. Now let's read the details of Asian section. What happened at the Asian section? The Asian section was giving me what? Trend lines. Nothing but trend lines.